Good evening.
Good evening to you.
Now, the last time we met, we were discussing cost of capital, if I remember, and we did an example. How many examples did you do from the past paper? That is from the question bank. I think we did a question. I'm not so sure. I just want to confirm. How many questions did we do from the past paper? John, you were in class last time, I guess. As well as Thomas. One of you was, I think you were in class. Thomas.
I think we did question 1.
We did, sorry, which page was it?
Page 5, question 1.
On one question, page 5, question 1. On one question.
Can you check the other one?
John, confirm. Okay, let's attempt to do the question together. So in part A, being asked to get the company cost of capital, okay, using the market weight basis. Okay. Okay, I was getting a screenshot of the question. Okay. So we say the first step when it comes to getting the cost of capital is first determine the company cost source of capital, and here there's equity. We have the 10% bond, and we have we want to get only for KFP because that's what the question requires of us. We need to get the cost of capital for KFP. So for KFP, KFP has equity. It has equity and it has the 7% bond. That is it. Okay, that's a very easy question then. Okay, so KFP has only two financials. Okay, it has a 10% bond, and it has the equity. So you can beat by getting cost of equity. Okay, first determine the first step, as you've done, is determine where the money is coming from. Okay, from two sources, equity and the bond. Okay, next step is to get the cost of capital from each of those capital sources. So we can begin here, cost of equity. We want to get the cost of equity. And you see that you can use two models. You can use the dividend growth model, or you can use the capital asset pricing model. Okay, and as per the information given for KFP, I can see there's an equity beta. We have an equity beta. We have what else? The risk-free rate of return, and we have the market return. So that will be therefore you're going to be using the capital asset pricing model. Cost of equity will be equal to risk-free equity beta for KFP. In terms of the market portfolio minus the risk-free rate of return. Risk-free, which is return on the market on the T-bills, for example, is 4%. Okay, equity beta for KFP is 1.2. The return on the market portfolio 10.5 minus the risk-free 4%. Therefore, what's the cost of equity for this company? Using the capital as a pricing model. Brenda, what do you get? Mercy, what do you get?
11.8.
11.8%. Okay, the cost of equity to be 11.8%. Okay. Then next we get the cost of this KFP as the 10% bond. So here, cost of bond KFP has the 10% bond. Okay. And it's going to be redeemed at par value in 7 years' time. Therefore, a number of years redemption 7 years. Okay, the interest to be earned is your tax here. Yes, we have tax. Okay, the interest to be earned net of tax will be equal to 7% times the par value of this bond, and the par value of the bond is 100. Okay, as per the paragraph given there below is 100. They pay an interest tax of that percent. Therefore, the net cost to the company, therefore, is 70% to give us 4.9. Okay, to give us 4.9 to be the net interest for the company. Okay, expense the company. Current market value P naught, okay, given is equal to 94.74. Okay, don't get here we use trial and error method. Okay, where we see that if we discount the cash flows, okay, at the correct discount rate, then the difference between the market value, okay, and the sum of those present value ought to be equal to 0. Okay, therefore negative and the current market value plus the interest 4.9 times present value and factor 7 years. Okay, number of years redemption 7 years. So 7 years, the cost of debt, okay, plus the redemption value 100 times present value interest factor 7 years R%. Okay, so R% being the cost of the debt, therefore the sum of the present value, sum of the interest, okay, sum of present value interest, and the sum of present value, sum of the present value of the interest and redemption value give us therefore 94.74. The difference therefore ought to be equal to 0. But don't forget this is a trial and error method. Okay, so what will be 4.9 divided by 94.74? What's 4.9 divided by 94.74? 4.9 divided by 94.74. What do you get in percent?
5.2.
5.2. Okay.
Yeah.
5.2. Then you can begin therefore discounting the cash flows at 5%. Okay, at 5%. This is a trial and error method, don't forget. Okay. Therefore, at 5%, this will be equal to negative 94.74. Okay, plus 4.9 times present value and factor 7 years 5% plus we discount 100 back to year 0 at 5%, 7 years 5%. Okay, what do you get therefore to be the sum present value minus the current market value. You get how much? Munir, what do you get?
I'm getting 4.711.
4.711.
Yes,
Positive, negative?
positive.
Okay, great. You get 4.711 to the 4 to be the sum present value of those cash flows. Okay, so you can increase the discount rate, let's say to 6%. Okay, we discount the same process, but now we discount at 6% to be equal to negative 94.74 plus 4.9 times present value earned factor, 7 years, 6%. We discount the redemption value back to year 0, present value index factor, 7 years, 6%. And get how much? Sharon, what do you get?
I'm not yet finished calculating.
Okay. Thomas, what do you get? Market value of equity?
126.
126 million.
Yes.
Exactly.
Yes.
Okay, 126 million. Market value of bonds?
14,211,000. Yes, like that.
That way. Okay, fair enough. Okay. The total market value of the two sources, therefore, will be equal to 140 million to 11,000. Okay. Now, having obtained the market value from each of those two sources, okay, now you can get, therefore, the weighted average cost of capital. So step three, weighted average cost of capital. We get the weight of equity. Weight of equity is therefore 126 million divided by 140 million to 11,000. We multiply the weight of equity times the cost of equity, which we obtain to be equal to 11.8 times 11.8 plus weight of debt, in this case, which is 14 million to 11,000. That's the weight of debt, okay, divided by 140 to 11 times the cost of the bond, which is equal to 5.84%. Give us how much to be the cost of the bond to the company, to be the company weighted average cost of capital.
$11.2.
11.2%. Okay, because therefore the cost of the debt, 11.2%. Okay, for 10 marks, and you can see it's not a very hard question to do. Okay. So let's go back and see whether they can get some few more questions, because this is an area where you do expect the examiner will most likely ask. Okay, when it comes to, if you check on your question bank, you'll see that this is an area where the examiner normally repeats. Okay, so I suppose that you're going to pay the required attention to that area. Okay, Let's go and get another question here. Okay, there's some area here we have not done that question, so let me just leave it for now. Okay, the same applies for that part. So this is an area we can be sure that there may be a question the examiner sets from this either section C or section B question, most likely section C. Okay, so it's worth enough we prepare it with that in mind. Okay, I guess we can do this. And company. Okay, I guess we can do this. Okay, there's a company called NN Company. Okay, NN Company. Page 24, 25. NN Company, page 24, page 25. Part B and C. These can do part B and C. NN Company, part B and part C. Okay, so go through it, then we discuss together. NN Company, page 24, 25, part B, C. Okay, go through it, we discuss together. So we need to get the cost of debt for the company and get the weighted average cost of capital. Okay. So this company, it has a long-term borrowing made of 10% bond, okay, that can be redeemed in 6 years' time as its par value. The current market value of that bond is 103.5. Is there tax? Yes, there's tax, 25%. Okay, so we can do that quickly. So the cost of debt. Okay, this bond is its number of years to redemption is 6 years. The interest we earned on after-tax basis will be equal to 1 minus 0.25, the tax rate. We multiply by the interest we earn per year. The interest we earn, it is paying interest at 10% per annum with a par value of $100. Therefore, what's the interest after tax? $5 point. $5.25. Okay. The next thing we need to get is the current market value of this bond on interest basis, which is 103.5. Okay. So P note is 103.5. Okay, we can now be able to get the cost of this bond. What is 5.25 divided by 103.5? Don't forget, the reason why I'm trying to ask you that is, if this bond was to be redeemable, its cost would be equal to 5.25, okay, divided by 3.5, okay, and we express the percent, okay. Once we get to determine the cost of this bond, if it was to be redeemable, then that means therefore the cost of this bond, okay, will not be too far from the cost of the same bond if it was to be redeemable, okay. The idea here is to reduce the number of trials that you make. Anyway, so what do you get? 8%, that is
5.07.
5.07. Therefore, maybe we can begin at 5%. Okay. Okay, you don't need to show this working. Okay, just for your own understanding. Okay, so in the main exam, you may or not include it. It does not make any sense. If anything, I would not want you to include. I would not want you to include this, just in case the examiner thinks that you did it the wrong way. Anyway, So therefore, we know that the cost of the bond, therefore, it will be at somehow around 5%. Okay, so let's begin at 5%. At 5%, we discount the cash flows at 5%. We go to negative the market value on 3.5 plus the interest we earned 5.25. They're going to be earned for 6 years. Therefore, times present value earned factor 6 years 5%. Our first trial here, plus the redemption value. Okay, we assume it is at par value. It's given at par value times present value interest factor 5 years, 6 years 5%. And you get how much? Be the sum. Negative 2.25. Okay, but therefore we can reduce our discount rate to, let's say, 4%. Okay, so the same process, but now let's reduce our discount rate to 4%. So at 4%, it will be equal to negative 103.5 plus 5.25. We discount now at 4%, 6 years, but at 4%. 100 discounted back to year 0 from 6 years to year 0 at 4%. You get how much? $3.02. Okay, get 3.02. Again, therefore, the cost of this bond is between 4 and 5%. Therefore, the cost of this bond, okay, therefore, will be equal to 4% plus the difference between the two discount rate, which is 1%. The value of 4%, 3.02, 3.02 minus 2.25. You get 4 point.
4.57.
4.57%, and therefore the cost of this bond. Okay, that's the first part to be in as you get. That is as part B of the question. Part C of the question, we are meant to get weighted average cost of capital of the company. So first we need to determine where the money came from. So the money came from, just go back to the question. The money for NN company came from long-term borrowings, which I think we have just determined. Okay, this company also has preferred shares. Okay, it also has the equity. So we need to get the cost of equity. We need to get the cost of preferred shares. The cost of equity is given to us. That makes our work a bit easier, which is 12%. Okay, what else? The cost of preferred share, we need to determine that, okay, because it's not given to us. Okay, so we need to get the cost of preferred shares. Okay, so let's go and determine the cost of preferred shares. Okay, so cost of equity given to us here. Cost of equity, no need for calculation. We've been told is equal to 12%. We can get the cost of preference share, the cost of preference shares. okay, which will be equal to, and P is equal to the preferred dividend divided by the current market value of these preference shares. And when we express this as a percent, the preferred dividend is being paid at a rate of 8% of the nominal value, which is 50 cents. Therefore, the company is paying 4 cents as a dividend. Okay, the market value is 67 cents. Therefore, the cost of preference shares therefore will be equal to 4 cents divided by the market value, which is 67 cents, and we express this as a percent. This will give you how much?
$5.97.
Okay, you get 5.97. Okay, now we know that the next bit is to get the market value from each of those three sources. Okay, so let's get the market value. Okay, market value from each of these sources. So we can begin equity to get the market value equity. We go to debt and then go to preference shares. Okay, going back to the question. Okay, the market value per share, as per that paragraph just below the financial statement, okay, will be is equal to 8.3. Okay, market value is 8.3. We multiply by the number of shares this company has. Okay, the number of shares this company has. Okay, let me just go back to the question back. Okay, the number of shares this company has is equal to the total nominal value of the shares of this company is 50 cents. Okay, it's 50 million. It's 50 million, and the nominal value per share you've been told is equal to 50 cents. Okay, 50 million and 50 cents. Therefore, the number of shares of this company, therefore, is equal to 50 million. The total nominal value of the shares of the company, we divide by the nominal value per share, which is 0.5, okay, to give therefore 830 million. Confirm. Okay, that's the market value of the company equity shares, therefore, to be 830 million. The market value of the company bonds, okay, is the market value per bond, which will be told is 3.5. We multiply by the number of bonds issued, the total nominal value of the bonds of the company. Okay, let me just go back to the question back. The nominal value of the company bonds is 20 million, okay, which is here. And the nominal value per bond is 100. Okay, therefore 20 million, okay, divided by 100 to give therefore the number of bonds issued, which is 20.
$20.7 million.
20.7 million, 20.7 million, therefore the market value of the bonds of the company. Next, we look at the market value of the preference shares. Okay, the total, the market value per preference share is 0.67. We multiply by the number of preference shares issued. The nominal value per preference share is equal to 50 cents. The total nominal value of the company preference shares is equal to 25 cents, 25 million. Okay, 25 million. Therefore, the number of bonds issued, the number of preference shares issued, therefore, is 25 million divided by the nominal value per preference share is 0.5 million. To give us how much? 20.
33.5 million.
23. That's 3.
33.
That's 3.5.
Yes.
Okay. Sum total of the market value from the three sources.
$884 million.
84
$884 200,000.
200,000. That way. Thomas,
Yes.
confirm? Okay, great.
Yes.
Okay. Look at the market value from the three finance sources. Next, we are therefore the weighted average cost of capital. The money is coming from these sources, so we can be in equity whose market weight is 830 million divided by the total market weight of the three sources, 884.2 million, and that's therefore give us the market weight of equity, 830 divided by 884.2. We multiply by the weight times the cost. The weight is we obtain it. We multiply the cost of equity given to us as 12%. We get the weight of bonds, which is 20.7 million divided by 884 divided by time 0.2 times the cost of the bonds, which we got 4.57%, plus the weight of preference share, that's 3.5 million, okay, times the cost of preference shares, which we get to be equal to 5.97%. Okay, and that therefore will give us weighted average cost of capital to the firm.
%11.6%.
11.6%. 11.6%. Therefore, the cost of capital to this company. Okay, you can see they're quite straightforward, I guess. Okay. Any questions so far? Okay.
Question.
Yes, Thomas.
Part A had Roman 1 and 2.
Yeah, which I think they were asking about market value, isn't it? What are they asking? Thomas, what was part A and B asking? What about Roman 1, Roman 2 asking?
Yeah, they wanted to use different methods, how to arrive at it.
Sorry, what is this asking? Read what it is asking.
Calculate the equity value of any company using the following business valuation method.
Yeah,
Roman 1, dividend growth model, and 2 is net value.
Okay, this is a part of the syllabus we have not covered on valuation. Okay, it's a part of syllabus we are yet to cover. So I think the best is once we cover that area, we come back to it, isn't it?
Okay, thank you.
Yeah. Okay. Yeah, so I want us, okay, this is a question I can do here in page 39, page 39, question 3, page 39, question 3, a company called BKB. Okay, so BKB, page 39, a company called BKB company. Okay, so go through it. We discuss together. Page 39, BKB company. Okay, I suppose you have gone through the question and understood what the examiner was requiring from that exam, okay, from the students in that particular exam. So the required is we need to get the cost of capital for this company, explaining any assumptions you may have used along the way. Okay, and actually part B, I think this is part B of the question. Discuss why the market value with the cost of capital is preferred to book value. I think we did discuss this. Okay, why it is better to use the market value as opposed to use the book value when it comes to getting the cost of capital. Anyway, we go back to part A. 4 marks, so at least the 2 points that you mentioned, you discuss them in detail. So part A. So BKB company. So as I mentioned, we first begin by determining where the capital or the money is coming from. For this company, equity, there's equity, there is 10% convertible bonds, and there's 5% preference shares. Okay, so there are 3 finance sources. Okay, if we can begin the first one, the cost of equity. So equity for this particular company, okay, is equal to, so we need to determine that. Let's go through the notes given. If the company has an equity, beta of 1.2. Okay, the last paragraph, the equity risk premium is 5%, the risk free is 4%. That's mean therefore, based on that information, we can get the cost of equity. Cost of equity will be equal to risk free plus equity beta, return on the market portfolio, minus the risk free return. Risk free, you've been told, is equal to 4%. Equity beta is equal to 1.2. Don't forget RM minus RF. Okay, this is what we refer to as the equity risk premium. Okay, this is what we refer to as the equity risk premium. Okay, therefore, the difference between the two will be therefore equal to, we've been given is equal to 5%. Therefore, multiply by 5%. Therefore, what's the cost of equity? Therefore,
%.
and you get 10% with the cost of equity. 10% with the cost of equity. The next finance source for this company is the convertible bonds. Okay, therefore you need to get the cost of these convertible bonds. Okay, so cost of convertible bonds. Okay, cost of convertible bonds. Okay, so since these bonds are convertible, therefore that means we need to evaluate whether should it be converted or not. Okay, if they are the holder, would you ought to convert or not? So we get the conversion value. So first, let's get the redemption value. If we don't want to convert, then you redeem the bond and okay, market value. There is no mention on the redemption value, or is there? Can't see it. The convertible conversion ratio of 19, conversion date, redemption date at the same time. Or is there? Maybe I'm missing it. There's no mention. Therefore, therefore that becomes one of your first assumption, that we assume that the conversion occurs at the par value of the bond. Okay, don't forget, if you check part A, you are meant to explain the assumption you have used. Okay, and that's one of the assumptions. Therefore, we have used. There's no mention on what is going to be the redemption value. So we assume the redemption value is equal to the par value. So that's an assumption which you need to note down. Therefore, which will be 100. Conversion value is conversion ratio. We multiply the share price at the time of conversion, which is 5 years from now. Conversion ratio is number of shares you get per bond, which are 19. We multiply by the share price at the time of conversion. The current share price you've been given, we've just been given the total market value of the company share, which is 125 million. So here we need to get the market value per share. The total market value per share, okay, is 125 million. The number of shares, because we want to get the market price per share, is we divide therefore by the number of shares this company has. One share has a market value of, has a nominal value of $1, and the total nominal value is 25 million. Therefore, the number of shares this company has is 25 million. Okay. Therefore, the market value per share, therefore, is equal to $5. Okay. Therefore, the current market value is $5. Okay. Since the conversion occurs 5 years from now, we may want to estimate what will be the conversion, what will be the share price at the time of conversion. We told that the growth in the share price is 4% per year into the future. Therefore, times 1.04, and number of years is 5 years from now. Okay. Therefore, let's give therefore the conversion value. Okay. Don't forget another assumption here we've just made. Okay. Here is an assumption. Here is another assumption: is that we assume that the growth of 4% is going to continue into the foreseeable future. Okay. It is going to be a constant every year. It will be 4% per annum. So that's an assumption. Which of course we do make. And what's the conversion value? We compare with redemption value.
$115.52.
115.52. Okay. Now here, don't forget another assumption again to make is that the investors in this particular market, okay, the investors are rational. Okay, that's an assumption. Okay, that these investors are going to be driven by wealth. Okay, so which means therefore they will compare the value to be received from redemption and the value to be received from conversion. Therefore, they're going to be the one that maximizes the wealth. Okay, there's an assumption. It's not always the case, but you assume that these investors, they are wealth driven. Okay, that's another assumption which you need to state. Okay, that the investors are wealth driven. They are rational investors. Which means therefore we are going to therefore convert, since is more money compared to the case of redemption. Okay, we imply therefore the market value of this bond therefore will be equal to the interest we received on after tax basis. Okay, discount back to 0. Okay, 5 years R%. Okay, plus the present value conversion value. Okay, times present value interest factor, 5 years R%. Therefore, we use the trial and error method. Okay, as we've been doing the trial and error method. So the current market value of this convertible bond is how much? You've been given the total market value, so we need to get the market value per bond. Okay, so let's have a small look here. Market value per bond, the current market value per bond. The total market value of the bond, we've been told, is equal to 21 million. Okay, going back to the financial statement, the nominal value per bond is of course 100. Okay, so we divide by 100 to get, therefore, here we need to get, we divide by the number of bonds here. Okay, so this is divided by the number of bonds. Okay, so the nominal value per bond, the total nominal value of the bonds of the company is 20 million. Okay, as per the financial statement, and one bond has a nominal value of 100. Therefore, the number of bonds therefore is 20 million divided by 100. To get the market value per bond, therefore, we divide the number of bonds obtained by the denominator here, divided by 21 million, and you get 105. I'm just guessing. What's the market value per bond?
Yes, 105.
You get $105. Okay, therefore the market value P naught is 105. Okay, therefore the current market value of the bond 105. Okay, therefore 105 is equal to the interest. So you may want to get the interest here. Working for the interest, the net interest income, or the net interest expense of the company. This bond is paying the interest at a rate of 7% per annum. 7%, we multiply by the nominal value, 100 is your tax here. Yes, there is that percent tax, therefore, net of tax 0.3 to give us 4.9. Okay, therefore, the market value 105 is equal to 4.9. Discount back to your 0 at the company cost of debt, okay, at percent, 5 years. In the final year, we have conversion. So the amount received is 115.2. Present value interest factor, okay, R%, the cost of debt, okay, 5 years. Try another method. What would be the cost of this bond if it was to be redeemable? 4.9 divided by 105, what do you get? What would be the cost of this bond if it was to be redeemable?
$4.67.
4.67, therefore we can be in at 5%, okay? Therefore, at 5%, we go to negative 105 plus 4.9 times present value factor, 5%, 5 years, okay, plus 115.2 times present value interest factor, 5%, 5 years. You get how much?
$6.53.
0.5?
3.
Positive, negative?
Positive.
Okay, so therefore we can increase our discount rate to let's say 6%. Okay, and 6%, the same process. Negative 105 plus 4.9 times present value factor, 6%, 5 years, 115.2 times present value interest factor, 6%. Okay, 5 years. And we get how much?
6.35.
35.
Yes.
35% accounted therefore the cost of this bond. Okay. And lastly, this company also has preference shares, if I remember. Yeah, this company has preference shares. If you take at its SFP, okay, there's a 5% preference shares. So next is get the cost of preference shares. Cost of preference shares. Okay, to be equal to P will be equal to the preferred dividend divided by market value, and we express as a percent. Okay, so first let's get the market price per share for these preference shares. It will be equal to the total market value of this preference share, which is 6.25 million. We divide by the number of preference shares. Okay, the nominal value of the preference shares of this company as per the SFP is 10 million. The nominal value per preference share is 1 million. Okay, and this give us 2.5 cents. Okay, to be the market value per preference shares. Okay, having done obtain the P note. Okay, we need to get the preferred dividend. Now these preference shares are paying dividend at 5%, a rate of 5%. We multiply by the nominal value, which is equal to $1. They have to give therefore 5 cents to be the preferred dividend. Therefore, the cost of preference share therefore is a dividend 5 cents divided by the market value 62.5 cents. We express as a percent to give us how much? With the cost of these preference shares.
Eight.
Okay, 8%. Now, having obtained the cost from the three finance sources, okay, then we can be able now to estimate the cost of. Okay, another assumption that we have made, okay, is as you can see, if you look at the question, we know that this company has an overdraft, okay. However, we have ignored that, okay, the other finance, okay. Why? Because okay, it is not part of capital finance. If anything, is a short-term source of finance, the overdraft finance, okay. So therefore, we have ignored it altogether, okay. Actually, you can include it, okay, but I would propose that we ignore it altogether, okay. Why? Because the overdraft is more of short-term finance source. It's to finance the company working capital, not for the company long-term capital needs. Okay, therefore that is another assumption that we have made there. So we have ignored altogether the overdraft. Okay. So this is the cost of preference shares. So having done that, and we can get the company now with average cost of capital for this company. We begin with the equity, and the company has the equity market value is 125. So actually we need to get the total market value. Okay, so it can be a small working somewhere. Let me just put it down here. Okay, so the market value. Don't forget, all your workings need to appear on the paper. Okay, in this case on your Excel. Okay, so market values from these sources: equity, convertible, the preference shares, convertible bonds. Okay, as well as preference shares. Okay, equity 105 million. No need for working since it's already done. Okay. Convertible bonds market value 21 million. Preference shares market value 6.25 million. Total will give us how much? The total of the three capital sources.
$152.25.
152.25 million can therefore the market value from those resources. Therefore, the weight of equity therefore will be equal to 125 million. Okay, we divide by 152.25 million. We multiply the weight of equity times the cost of equity, which we obtain as cost of equity was how much? As 10%. We got 10%. 4 times 10%. Plus weight of next is the weight of convertible bonds, okay, which is 21 million, time the cost of the bonds, which you got 6.35, okay, plus the weight of preference shares, which is 6.25 million, time the cost of preference share, which is 8%. Okay, therefore, what's the weighted average cost of capital, therefore? Okay, get how much?
%9.4.
9.4% for the cost of capital for this particular company. Okay. Question. Okay, no question. Seems that the question was clear to all of you. And now I want to throw one question to you. Okay, I want to throw a question to you. So you make the attempt, you make mistake, and then you come back, we attempt to do it together. Let me see how far this is. Yeah, there's a good one. Yes, so page 42, okay, page 42, a company called AMH Company, page 42, AMH Company, okay, page 42, 43, we do part A, AMH Company, we do part A. Now, this is 12 marks, okay, so I want to give you 24 minutes, okay, so 12 marks, 24 minutes, okay, so right now it's 7:17, 7:18, so we come back here as 42, and this was 2. Yes, at 42, so 24, yes, at 42, so we meet here at 7:42, okay, with your work, okay, so at 7:42, I ensure that you have sent my work, then we meet together, we revise it together, okay, and I'll admit you based on you having sent your work, okay, so we meet at 7:42, having done the question, made the attempt, and having sent it to me. Clear? Okay, so it's good.
Sending the work.
Sorry, through email. You can send through email. I think that's much easier.
Okay.
Okay, so if it's what form, if you're going to have it scanned as a Word document, as Excel, whatever you want to present it. Okay, so I want to leave that to you. Okay. Okay, so this is a company called, and I prefer my work to be in Times New Roman. Okay, and in thousands. So I prefer my work to be in thousands where it is required. Okay. Anyway, so we can begin first, getting to know where the money is coming from. Okay, so capital source. Okay, can begin that to get to know where the money is coming from. the source of capital for this company, capital sources, okay, for this company. Okay, going through the financial statement, this company has equity share capital, so equity, we call this equity, okay. The company also has, as per the paragraph just below those financial statements, the share capital is made of two, the ordinary share capital and the preference shares. So we also have preference share. So next we have preference share. Preference shares. And as I told, don't forget, there's no any penalty for typo. So in case you make a typo, so don't worry about it. If you get time, you can come back and correct it, okay? But there's no penalty for any typo that you make, okay? And then towards the borrowings consist of notes, okay? Therefore, next is notes. The borrowing consists of notes as well as the bank loan. So the notes, and here we have the bank loan, okay? Bank loan, okay? So that is therefore the four sources of capital for this company, okay? Equity, preference share, notes, as well as the bank loan, okay? So the next, which is a bit easier to obtain, is actually to get the market value. So the next can be how therefore to get the market value for each of those three sources, okay? Market values. Now equity, for the case of the market value of equity, so we need to get the market value of equity. The total nominal value of equity is 12 million, okay? Therefore, 12 million is total nominal value, okay? So 1, 2, 3, 1, 2, 3, okay? Just confirm, yes, this is 12 million, okay? 12 million. We divide by the nominal value per share, and the nominal value per share, you've been told, is equal to 0.5. Therefore, divide by 0.5. This therefore give us the number of shares in this company. Okay, we multiply by the market value per share, which we've been told on X dividend basis is 7.07. Don't forget the market value P naught is always on X basis, which is 7.07. And that therefore give therefore the market value for the case of the equity shares of the company, which is given therefore 169,680. Clear? Okay, let's give therefore the market value for previous shares of the company. Next, we get the market value of previous shares of this company. The number of previous share which will be equal to the total nominal value of previous share, which is 5 million. 5, 1, 2, 3, 1, 2, 3. Just confirm. Yes, it is okay. Divide by the nominal value per preference share, which is equal to 50 cents. Therefore, divide by 0.5. Okay. We multiply by the market value per preference share, which will be equal to 31 cents. Therefore, times 31 cents. Okay, 0.31. Now they'll give the market value of preference shares. Clear? Okay. Next, we get the market value of notes. Okay, the market value of notes. Give me a second. Okay, not cent. Okay, so next we get the market value of the notes. Okay, in this case we need to get therefore the number of notes issued, and we told that the nominal value of the notes is 10 million. Okay, therefore 10 million equals 10 million. 1, 2, 3, 1, 2, 3. Just confirm. Let me enter C. Yes, this is okay. 10 million. Divide by the nominal value per note, which is 100. We multiply by the market value per note, which we told is equal to 102.34. Okay, that's the market value per note. That you have given therefore the total market value of the notes of the company. And this is a bank loan, it has no market value, so we use the book value, which is 3 million, as we've been told there, 3 million. Okay. Clear? Okay, it is. Therefore, we get the sum of the market value of all those four finance sources, capital sources. Therefore, equals sum of all these. Therefore, that's given for the total market value of the four capital sources of the company. Okay. Next, we get the cost of capital from each one of them. Okay. Therefore, cost of capital. Okay. So maybe here you may require workings. So you can begin here again the cost of equity. Okay. Cost of equity. So here we get cost of equity. So based on the information given to us, they are going to therefore be used. We have the dividend. That be therefore we can now be able to use the dividend growth model. The dividend growth model. Okay. This is the cost of equity. as per the dividend growth model, we need to get the most recent paid dividend, which is D naught, okay, which is equal to the most recent paid dividend of the company. The company currently is trading cum dividend, okay, is trading cum dividend, which is equal to 7.52. Okay, 7.52. That is the current, the share price, the value of the share with the anticipation of the dividend, okay, called the cum dividend, okay, which means therefore if there was no dividend, the company is anticipating the share price was 7.07, okay, it's 7.07. Is 7.07, which means therefore the difference between the cum dividend and the ex dividend is a dividend, okay. Now, since the shares of this company, are already trading with this dividend and being anticipated, which means therefore this dividend of 45 cents is going to be paid in the next maybe few days, okay. Don't forget the reason as why the shares of this company are trading cum dividend is because there's anticipation, okay, that in the next few days the company will be paying dividend of how much? 45 cents, okay. Now, since the share price is cum dividend already, therefore the 45 cents is a D naught, not a D1, okay. It's a D naught, not a D1, okay. Why is it a D naught? Okay, because it is getting paid in the next few days, okay. If it was to be paid in the next maybe 4 months, then the share price will not become dividend, okay. The share will be traded with the anticipation is too far, okay. It's 4 months, okay. Then the share price will be traded at its correct its true value, okay, the P naught, okay. Is that clear? Because don't confuse, because if maybe this dividend, this 45 cents was to be paid maybe in 3 months time, then it becomes D1, not D naught. But since the share is already trading with that anticipation, then it becomes therefore D naught. Don't forget, D naught is the most recently paid dividend. This 45 cents is yet to be paid. So therefore, it seems more to be as D1, but it's not D1. Why? Because the share price is already trading cum dividend. Is that clear? Because you may get confused, because once you confuse there, you can then going to get it wrong altogether. Clear, John?
Yes, it's clear.
Okay, great, because there you can make a mistake, okay? You consider this as D1, whereas it's not D1, it's D naught, okay? Okay, having done that, what's next? Okay, we have D naught, so what else? We need the growth in the dividend, okay? Next, you need the growth in the dividend, say for G, okay? And the growth in dividend, therefore, will be equal to the 45 cents, which is about to be paid, okay? Divided by the dividend at the beginning of the time period, which in this case was, let's say, 2013. By that time, it was 37 cents, okay? And this growth from 47 to that, from 37 to 45 has been experienced over how many years? 4 years, isn't it? Because it's from 2013 all the way to 2017. Is that clear? It's from 2013 all the way to 2017. Marcy is clear?
Yes.
Okay.
Yes.
Okay, this is 4 years, okay, from 2013 to 2017, not 2016. Okay, because 2016 we have another year after 2016. With this case is the for 2017, which is the 45 cents we have here. Okay, hope that's clear. Janice is clear.
Yes.
Okay, great. Okay, so this growth is experienced over how many years? 4 years. Therefore, the power of a quarter. Okay, the power of a quarter. Well, they're 4 years. Okay, minus 1. Okay, if you remember, don't forget the G. Let me just remind you. The G. Yes. The G is equal to, okay, D 2017. We divide by D 2013. Okay, over 4 years of growth. Okay, quarter minus 1. This is just what I've done in this cell here to give us 5%. Clear? Munir, it's clear?
Yes.
Okay, great. Okay, so that's on how to get the growth. So I think we have all the variables we need to get the cost of debt. Okay, which will be equal to the cost of debt to be equal to, okay, just call it cost of debt to be equal to D naught, okay, we multiply by 1 plus the growth, okay, 1 plus the growth, okay. We divide by the P naught, the market value of the shares of the company, divide by P naught. The P naught, which we got was 7.07, okay, plus the growth, okay, which is 5%, okay, to give us 5%. And that's therefore will give us therefore the cost of equity for this company. Clear? Okay. Okay, let me just put this in brackets also. Okay, and that's therefore 12%, therefore will be the cost of equity for this company. Is that clear? And don't forget what I've just done. The cost of equity for the company is equal to, it's too big. Okay, cost of equity for the company will be equal to D naught 1 plus G divided by P naught, okay, plus G. Okay, D naught was 45 cents. Okay, G is 5%. P naught was 7.07 plus the G. Okay, let me just refer back to the formula just to see what we have just done. Okay, B9, where is this? Okay, don't get, where is this? What's happening? I can't use my cursor. Yeah, here it is. Okay, don't forget B9 is, what is B9? B9 is the dividend which you got here for 5 cents. Okay, so it's simply right here. My cursor not happening. Yes, okay. So don't forget is equal to, okay, cost of debt, the cost of debt will be equal to, okay, 45 cents, okay, grow the 5%, 1.05, okay, we divide by P naught, which is 10.07 plus 0.05, okay, that's what it is here. But since it's Excel, you don't need to have to show this formula. You don't need to do that, okay, don't waste your time. You simply need to fill in the formula into that cell that you have just done here, and again to give you the answer, okay, so you need to make your work easy. Brenda, it's clear?
Yes.
Okay, great. Okay, that therefore give us therefore the cost of equity. The cost of equity for the company to be equal to 12%. Okay. Next, this company also has private share, so let's get the cost of private share. So next is cost of private share. Cost of private shares. So in the case of cost of private share, we said it's given us the preferred dividend. We divide by P naught. So we need to get the preferred dividend for this company. Okay, is equal to the preferred dividend of this company would be equal to this preferred share is paid at what rate? It is paying at what rate? 5%. It is paid at 5%. Therefore, 5%. Okay, sorry, 5%. We multiply by the nominal value of this preferred share. And the nominal value you have seen is equal to 50 cents, 0.5. Okay, that therefore give us the preferred dividend, 5% or 5 or 0.5. We divide by the current market value of this preferred share, which in this case is equal to that 1 cent. Divide therefore by that 1 cent. Okay, that 1 cent, and that therefore give us the cost of preferred shares. Okay, to give us that 1 cent, to give therefore a cost of 8%. Okay, don't forget it's simply because of preferred share is the preferred dividend divided by P naught, okay, times 100%. The preferred dividend was equal to 5% of the nominal, which is equal to 50 cents. Okay, there was 50 cents. Okay, divide by the market value. This is equal to 2.5 cents. Okay, 2.5 cents. We do a market value, which is that ones. Okay, therefore cost is equal to this. Shows up at my screen, it's freezing. Back, okay, will be equal to the cost of preferred share will be equal to the preferred dividend, 2.5 cents. We divide by the market value, which is equal to that 1 cent. Okay, that therefore give therefore the market value of the cost of preferred share. Okay, which we have here. Just refer back. Okay, 5% of 0.5 we divide by that 1 cent to give therefore the cost of the preferred shares. Clear? Okay, that's clear. Next, we can get the cost of what else can I get? The cost of notes. Okay, that's the next thing. Cost of notes. Okay, so the cost of this note for this particular company, this note, they can be redeemed. When can they be redeemed? In 4 years' time at 5% premium. Okay, in 4 years' time at 5% premium. Okay, so the number of years to redemption is 4 years. So we can have year 0, year 1, 2, 3, and 4. Okay, the interest we earned, we call this interest we earned. Okay, let me just put on us like this: the net interest we earn per year will be equal to, it is paid interest at 7%, therefore will be 7% times the nominal value of this bond, which is 100. Do you pay tax? Is there tax payment here? Yes, 30% in the first line, just before the SFP, 30%. Therefore, 1 minus 0.3. Okay, 0.3. Therefore, therefore 4.9. Therefore, to be the interest to be earned in year 1, in year 2, all the way to year 4. Every year you'll be earning that. Okay, so every year you'll be earning the 4.2. Okay, 4.9. Sorry. Okay, from year 1 all the way to year 4. Now, in the final year, which is year 4, don't forget this is the final year. Therefore, going to be getting redemption value back. Okay, therefore, over and above the interest, you'll be getting something else. Therefore, plus redemption value, which is equal to 5% premium to the par. Therefore, the redemption is at 105, 5% more, which is 105. Okay, therefore, the final year cash flow to be 109.9. Okay, then in year 0, don't forget it's P naught, the market value. If you remember, what we had was negative P naught plus interest. Discount then back to year 0 plus the relevant factor. N years are percent as per the formula, that is. Okay. Redemption value, discount back to year 0 plus the relevant factor. N years are percent. So you've done this bit, the interest from year 1 to year 4. You've done this bit also. So here in year 0, P naught means 0. Okay, is negative market price. Negative market price. Therefore, in year 0, the negative market price for this bond is 102 points. So it will be equal to negative. Therefore, it will be equal to, in year 0, negative 102.34. If that's therefore the market value of the current bond Okay, let me just above this. Okay, okay, I'm just picking the whatever you have here from year 1 to year 4 from our formula. Okay, year 0 to year 4. We want to get the cost of bond. Okay, we use therefore the IRR formula. Okay, the cost of the bond, we use IRR formula equals IRR. Okay, from year 0 all the way to year 4. We highlight all the cash flow from year 0 to year 4, and that therefore give me therefore the cost of the bond, which is equal to 5%. Okay, clear? Okay, that's great. What else? We need to get the cost of loan. Okay, cost of bank loan. So the cost of the bank loan is simply the interest you pay. And this bank loan, the interest you pay is how much? Yes, sure, John.
Question. How did you arrive at the 5%?
At the 5%?
Yes.
Okay, at the 5%, I use the IRR formula. Let me just show you. Okay, I use the IRR formula because don't forget the method we've been doing so far, okay, which was a trial and error. The final formula is the IRR formula. Do you remember? Let me just go back, okay, to some of the work you've been doing so far. Where is this? It is. Where is this? Yes, here it is. Okay, don't forget this is the IRR formula. You remember this formula, John?
Yes.
Yes, don't forget, since now you have the Excel, you don't need to do this, okay? It's going to make you accurate. You don't need to use the try and error method, since the Excel itself has the IRR formula. Okay? Is it clear, John?
Yes, it's clear.
Okay, that's why here I just use the IRR formula, okay? Equals IRR, but what you have to be careful with the IRR formula is you have to define the cash flow from year 0, okay? From year 0 all the way to the end year, okay? Don't forget year 0 is included here. And year 0 has to be negative, okay? That's why you can see therefore ID put negative 102. So here 0, because it's from the formula, it was negative P naught. Okay, let me just refer back. Okay, for the sake of answers as study. Okay, here 0 was negative. And here it is, for example. Okay, here is a negative. Okay, a negative plus all these are cash flows. Okay. The first is a 0 is a negative, don't forget. Okay, so in case you want to use the Irr formula, which of course is very easy to use. Okay, anyway, so but you have to be quite careful. Okay, here 0, you start the cash flow must be a negative. Okay, clear, John?
Yes, it's clear.
Okay, great. Okay, then next we do the cost of the bank loan. Okay, this is a bank loan, therefore the cost is simply the interest you do pay. Okay, net of the tax savings. This, how much interest does this pay? Now, this is a bank loan that has a variable interest rate. Okay, it has a variable interest rate. Therefore, since this is variable, we have to look at, does this company has another debt instrument? If it has another debt instrument, what do? We take therefore the cost of that other debt instrument to be the cost of this bank loan. Okay, well, there's an assumption that we make. Okay, actually, okay, but we assume since this bank loan is variable, okay, which means therefore its rate is fluctuating. Okay, what do? We can assume, or we just pick, determine therefore the cost of this bank loan will be the cost of any other loan instrument that this company has. In this case, this company has a bond. Okay, therefore the cost of the bond becomes the cost of this bank loan. Okay, which therefore is equal to the 5% here you have here. Okay, clear, Mercy?
Yes.
Okay, great.
Yes.
Okay, you know, we have the cost of the bank loan, the cost of the bond, the cost of the preference share, the cost of the equity. And be careful, don't mix up. Don't forget these percentages. I'm not the one who have to put them here. Okay, it's just simply the question has picked up as percentages. Okay, if you convert, for example, this cost of preference share is 0.08. Okay, I've not converted to percent. Okay, so because you may end up mixing, you multiply by 100. Once you multiply by 100, that is a different value altogether. Okay, so be careful. If I would propose it, don't convert them to percentages. Okay, so even here, let me just take the formula so that you get it. Okay, so here I now multiply by 100. Okay, if it was in the paper format, I would have multiplied by 100. Okay, so that I can see the percentages. Okay, but since it's Excel, it's not worthwhile. Okay, we're going to end up getting a different answer together. Okay, so don't multiply by 100. Okay, so in case they are 0.0, let them stay like that. Okay, because if I multiply here by 100, okay, I multiply here by 100, then I'll be getting 8. And 8, if I use a percentage, it'll become 800%. Okay, so don't multiply. Okay, don't multiply, just leave the way it is. Okay, it's much better don't, because if you multiply, you will end up with making mistakes. Okay, here there is 5%. It was picked by the computer because this is IRR. Okay, it's meant to be a percentage. So it's the computer that picked it automatically as 5%. Okay, is that clear? Because that's a mistake that you normally make. Okay, if you convert the figures to percentages, then all of them convert them. If the figures remain as without, like in this case, I never did convert into percentages. They don't convert into percentages. Okay, they are the figures. Otherwise, you're going to end up having decimals and percentages, because therefore it's going to end up with a wrong case, a wrong answer altogether. Okay. Now having done that, therefore we can come back here. Cost of capital, I can simply make the reference to what we got. We got 12%, so enter. Cost of preference share, we have done that, 8%, enter. Cost of notes, we've done that, 5%, enter. And don't transfer them manually, otherwise you're going to end up transferring wrong things. Okay, transfer them, make reference to the cell. Okay, it's much better. Okay, so in case there were, don't forget, for example, I'm very sure this is a point something. Okay, so in case you pick manually, you're going to be entering 5%, but this is not 5%. It's actually maybe 4 point something. Let's see. Actually, let's see whether it's going to be 5 point what. I'm sure this is going to be. It just has a decimals. You can see it has decimals. Okay, so don't pick manually. Just make reference to your workings of the Excel itself. Okay, otherwise you get end up with wrong answers altogether here. Okay, so be quite careful. Anyway, so therefore next you can get the weights. Weights, okay, for each capital source. Therefore, for equity, it will be equal to the market value of equity. Okay, we divide by the total market value. Okay, so this is total market value, which therefore remain constant. Therefore, I can lock it. That's the rate of equity. So since I have locked the workings there and I have the formula, I can drag down to all the 3 sources. I'm going to drag down my formula to all the three of them. Okay. Now, cost of capital, therefore, okay, you can call this cost of capital here with average cost of capital in this cell will be equal to the weight times the cost. Okay, weight times the cost. Okay, maybe I can do weight times the cost be equal to. Okay, let me just work it out here to avoid confusion. Okay, to be the weight. Okay, so here I want to get the cost of capital, weighted average cost of capital here. Will be equal to the weight, okay, times the cost, which got 12%. Okay, we do that for the four of them. I have the formula here. I drag it down. Okay, and therefore cost of capital of the company, which is average cost of capital of the company, is the sum here. Okay, the sum here equal to sum of all the workings above there, from the equity all the way to the bank loan. Okay, to give therefore 11%. Okay, you can want to know what it is exactly, and you get 11.19% to be the cost of equity for this company. Clear? So as I've said, let me repeat this. If you want to use decimals, use decimal throughout. Don't convert values to percentages, okay? By multiplying by 100%. Don't. If you want to multiply, then everything should multiply everything by 100%. So that the answer does you don't get it up with wrong answers. Okay. So I'll propose that you be consistent. Okay. Okay, the reason why this is 5.39% is because it was computer generated. Okay, I did it manually. Okay, the computer did pick it up. Clear?
Could you show the formulas for the weights?
For the weights, okay, formula for the weights.
0.91 and 0.02.
Yeah, those are the formulas for the weights, okay. Okay, that's okay, John. John.
Sorry, I had some network issue.
Okay, okay. It's okay?
Could you explain a little bit?
On the weights?
Yeah, the values that you used.
Okay, the value I used. Okay. Very far back. Now here, to get the weight, get my pen. Yes, okay. The weight of equity, for instance, will be 69.6 million divided by the total market value, isn't it? Therefore, it will be 169.68 divided by 186.014, isn't it?
Yes.
Which I have therefore, this is 91%. Okay, for previous share, the weight is equal to 3.1. Was what I have here. It's a different pen here. 3.1. Okay, divide by 186.014. That's the weight for the weight of previous share, isn't it? For the notes, the same. Okay, it's different. Ink will be equal to weight for notes will be equal to 10.24 million divided by 186.014. Weight of the bank loan will be 3 million divided by 186.04 million. Yeah, John?
Yes, it's yeah.
Okay, okay, great. Okay. I think I'll share this Excel with you so that you can see what you have done together here, okay, for your future references. Okay. Any other question? And you can see this, you can do it within 2 minutes, okay, maybe 3 minutes, okay. That is in case you've done enough practice, okay. This you can do within a very short time, okay, in case you know how to do it for sure. It's about making practice, okay. So make as many practice as possible, okay. That's what I would propose for your own sake, that is. Janice, any question?
No.
It's clear.